let's do the 13.4 work together. And it is on page 394 in your book, and it also has the information here in Mind Tab. So it says that Klitsky Corporation had net income and taxable income of $95,000 before depreciation and interest revenue. In addition, they identified two items that will cause differences between net income and taxable income. So A, it says on January 1st, they bought office furniture for $49,000. They'll depreciate it using straight line depreciation, no salvage, 7-year life, estimated life. For taxable income purposes, depreciation is $12,250. And then it says on December 31st, they received a check for $2,500 for interest earned on a tax-exempt bond. So the first step, it says, is to identify each difference between net income and taxable income as permanent or temporary. It says to use a V for a check mark. So depreciation, like we talked about, is a temporary difference because the book and tax will all catch up and ultimately end up having total depreciation of the same amount eventually. And then interest income is a permanent difference like we discussed, because if it's on a tax-exempt bond, for tax purposes, we will never, ever, ever record the income. Only for book purposes will we record the income. Then it says to step 2, calculate the straight line depreciation for the office furniture. So it said that it cost $49,000 and there was no salvage value, so we'll divide that by the number of years estimated life, which was 7, and that would be $7,000 of expense. So then down here for step number 3, it says to calculate the net income and the taxable income. Oh no, step 3 only says to do net income, and then 4 will do the taxable income. So for step 3, we're going to do net income before depreciation and interest, which they told you was $95,000 at the beginning. And then we will subtract depreciation expense. Oops, I can't spell. And that depreciation expense we just computed there at the top of the screen is $7,000. And then we'll add the interest. Sorry, I didn't do add. Add the interest revenue, because for book purposes we earned it and we record it. $2,500 it told us, to get what our net income is. So if we do that, we would get $90,500. So that is our book income, our net income. Then the fourth step says to do taxable income before depreciation and interest. Same number. We're starting at the same spot for book and tax. We will subtract the depreciation expense. And that is $12,250, which they told us in the directions for tax purposes. And then we would add interest revenue. And I forget what the directions said. Value to enter is 0, enter 0, instead of leaving the cell blank. So even though they wouldn't record it for tax purposes, we're putting a 0 there because it's a tax-exempt interest on bonds. And then that is equal to our taxable income. And if we add and subtract that outright, we get $82,750. So you can see when we check our answer that we're good to go. So for book purposes, I would record net income of $90,500. For tax, I'd only record $82,750, which means I would be paying less tax than if I didn't get those benefits of tax-exempt interest and accelerated depreciation. That's it for this work together.